Most people think banks make money like this. You deposit money, they lend it out, they charge interest. End of story. That's a nice bedtime story. It's also wrong. Yes, banks do make money from loans, but for big US banks, that's not the main game anymore. The real money comes from fees, financial plumbing, trading, and playing middlemen in ways most people never see. Today, I'll show you where big banks actually make their money, why lending is almost the least interesting part, and how banks figured out how to get paid whether the economy is booming or collapsing. By the end, you'll understand why banks don't really care about you saving money, they care about you using money. Let's start with loans. On paper, loans look great. Bank lends $100,000, charges 6% interest, collects money for decades. But in reality, loans suck. Here's why. Loans are slow. Loans are risky. Loans require capital reserves, and people don't always pay them back. After 2008, regulators forced banks to hold more capital against loans. That made lending expensive for banks. So banks adapted. Instead of betting on one borrower for 30 years, they asked a smarter question. How do we make money every time money moves instead of waiting for interest? That's when banks shifted from lenders to financial toll collectors. Fees are boring, which is exactly why banks love them. Overdraft fees, account maintenance fees, wire transfer fees, ATM fees, late payment fees, foreign transaction fees. None of these require lending money. None of them require risk. Most of them are automated. Example, an overdraft fee might be $35. It costs the bank a few milliseconds of computer processing, zero capital, zero long-term risk. Multiply that by millions of customers, and you've got a money printer that never shows up in commercials. Big banks don't advertise this because people hate fees. Fees feel unfair. Fees are hard to justify morally, but from a business perspective, fees are predictable, scalable, and brutally efficient. That's why banks spend more time designing fee structures than improving interest rates. Here's where things get interesting. Every time you swipe a card, tap your phone, or send money digitally, banks get paid. Not always directly by you, often invisibly. Behind every payment is a chain. Your bank, the merchant's bank, card networks, clearing systems. Each step takes a small cut. It might be fractions of a percent, a few cents per transaction, but payments happen trillions of times. Banks realized something genius. Instead of lending money and waiting years, they could tax movement itself. This is why banks love debit cards, credit cards, instant transfers, business payment processing. They don't need you to be rich. They just need you to spend, move money, repeat forever. A broke person swiping daily is often more profitable than a rich person parking money and doing nothing. Now let's talk about the part banks don't want you thinking about: trading. Big banks don't just hold deposits, they actively trade stocks, bonds, currencies, derivatives, interest rate products. But they don't usually gamble like Wall Street bets. They act as market makers. That means someone wants to buy, someone wants to sell. The bank stands in the middle and takes a spread. Tiny margins, massive volume. And here's the key. Banks often see orders before the rest of the market. Not insider trading, but informational advantage. They know who's buying, who's selling, how urgently, and in what size. That's insanely valuable. So while retail investors argue online about stocks, banks quietly skim value from every trade. Low drama, high consistency. This is one of the cleanest businesses on earth. Asset management. Banks manage pensions, retirement funds, ETFs, mutual funds, institutional portfolios. They charge management fees, performance fees, administrative fees. And here's the trick. They get paid whether markets go up or down. If markets rise, look how smart we are. If markets fall, well, long-term investing is hard. Either way, fees keep flowing. This is why banks aggressively push retirement accounts, managed portfolios, and financial advice. Not because they care about your future, because steady AUM fees are beautiful.